Welcome to The Explainer. Today, we're digging into a credit crisis that's building up kind of quietly, right under the market's nose. Now, this isn't your typical story about oil price spikes. It's about a wave of corporate distress that could seriously reshape the credit markets for years to come.
Right. This isn't just about a short-term shock to energy prices. What we're looking at here is a chain reaction, a financial stress that's just building on itself. And frankly, by the time this stuff hits the headlines, it'll be way too late to get ahead of it.
All right, so who gets hit first? It's the airlines. You can think of them as the canary in the coal mine for this kind of energy shock. And believe me, the signals they're sending out are flashing bright red. So take a look at this. This chart really shows you just how big the problem is. Their actual costs for jet fuel are running anywhere from 40 to 60% higher than what they planned for in 2026. Now, sure, hedging helps a bit, but for the part they haven't hedged, they're on the hook for what's called the Hormuz premium, that extra cost baked in because of all the geopolitical risk.
And what does that look like in real money? We're talking up to $1 billion in costs they just didn't plan for one airline. For any carrier with already thin margins, especially those in emerging markets, that is a potential death blow. We're talking defaults on their unsecured debt.
And you know, we've seen this movie before. Just look back at 2008. When oil prices stayed that high, there was a direct line to a spike in airline bankruptcies. If the situation we're in now continues, we should absolutely expect to see that happen all over again.
So the trouble with the airlines? That's really just the tip of the iceberg. It points to a much deeper problem that goes right to the next link in the chain, the energy refiners. And for them, it's not just about the price of oil. It's about, well, the actual chemistry of the oil itself.
Okay, so here's the key concept. It's what people in the industry call a crude quality mismatch. The thing is, not all crude oil is the same. You can't just swap one type for another without causing massive headaches and costs. And that is exactly the problem Asian refineries are wrestling with right now.
This really breaks down the technical and the financial problem. See, refineries in Asia are built for a specific kind of crude, the medium and heavy sour stuff that comes out of the Gulf. But now, they're being forced to use these lighter, sweeter alternatives, like WTI or Brent, and their machinery just isn't designed for it. That means less output, and the stuff they do produce, it's less valuable.
So what you get is this double squeeze on their profit margins. Think about it. They're paying more for crude that their refineries can't even process efficiently, and at the same time, they're getting less valuable products out the other end. The result? Their profitability, things like the crack spread, just gets crushed. For some of the older plants, especially in places like Japan and South Korea, this could mean shutting down for good.
So you see how this is spreading? The stress we're seeing in airlines and refineries, it's not staying contained. It's starting to bleed into the broader financial system, creating a systemic risk. And the big institutions, they're starting to sound the alarm. I mean, listen to the IMF. They're basically saying, don't get complacent. They're pointing out that if this crisis drags on, it could force all these highly leveraged players, hedge funds, you name it, to start selling off assets in a panic. And that could trigger a chaotic, contagious unwind across the entire market.
And this is why we're calling it a slow-motion crisis. It doesn't happen overnight. It builds. You can see it on this timeline. It starts in month 1 with profits getting squeezed. Then, by month 3, the credit rating agencies catch on and start downgrading debt, which chokes off access to cash. By month 6, that's when you start seeing bankruptcies and messy restructurings, because these companies simply can't refinance their debt.
Okay, so let's bring this all together. What does this mean for you, for investors, and why is this so critical right now? Well, it boils down to one simple and frankly pretty alarming fact about how the market is looking at all this.
And here's the absolute key takeaway. Right now, the credit markets are betting this whole thing is just a temporary blip. They're pricing it like it'll be over in a few weeks. What they are not pricing in is the scenario where this drags on for 6 months or a year, which is exactly the scenario that would kick off that cascade of defaults we just talked about.
If this crisis stretches out, we could be looking at some really severe consequences. We're talking at least 5 global airline bankruptcies. We're talking refinery shutdowns in Japan and South Korea, billions, maybe $50 to $100 billion in corporate debt that needs to be restructured. And on top of that, at least a couple of emerging market countries facing sovereign debt crises. None of that is baked into today's prices.
Look, just because it's in slow motion doesn't mean it isn't coming. It just means that when it finally hits, most people are going to be completely caught off guard. So for any credit analysts, any portfolio managers watching this, The time to stress test your portfolios against this specific risk is right now, before it's too late.
So, that really leaves us with one big question for every analyst, every investor out there. We've laid out this chain reaction, right? From the airlines to the refiners, all the way to the wider corporate debt market. Where do you think the first crack is going to appear?